Hello, everyone. I want to talk for a minute about timing the market and how to really win at timing the market. And when we hear that term, a lot of people think about the stock market and buying low when things crater and then selling out at the top. But nobody really knows how to time it. Nobody knows what that graph looks like tomorrow. And in real estate, the timeline is a lot longer, a lot slower, and things don't move as quickly. So I want to talk about timing the market in another way, and it's more about motivations. So as a law firm, we represent both buyers and sellers in a given transaction, and people only enter into these transactions when it's a good deal for them. And I'm going to come back to that win-win at the end of this video and say, look, you're timing the market as a buyer when you go into a transaction, and the person on the other side, the seller, is timing the market for themselves on the other side. And it's all about the motivation of what they need at a given time and what you need at a given time. And lots of beginning investors talk to me at different events, and they'll say, well, what's the right way to do this? I'm thinking about this kind of investment strategy or that kind. And I just tell them, look, there's no right or wrong, right? Everybody's got their own investment strategy. And guess what? It's going to be different as you time the market and go forward in your investing career. And what's right today is not going to be right for you tomorrow. So you have to learn how to handle your different motivations at different times. So when a deal does come together, it's because the buyer and the seller, through their own motivations, are timing the market in the right way for them. So let's look at a couple different situations and decide what's really happening there. Some buyers and sellers are cash flow buyers, and they only want cash flow, and they're very interested in their income and increasing their income. And you think, well, of course, everybody wants more income. Isn't that the point of an investment? Maybe, maybe not. So other investors are the opposite of that. They do not want cash flow. So they look for investments that are really not even cash flowing at all, because the income to them is a negative. The income is just a tax burden for them, and they really don't want to have more cash flow in this particular scenario. So they're the opposite of that. So here's two different buyers. One is a cash flow buyer. The other one, no cash flow, right? And you're thinking, well, which one's right? They're both right. Depends on the scenario of what their motivation is at that moment and why they're buying. So the buyer and seller that are looking at a no cash flow scenario might just need to park some cash for a while and then activate that cash someday in the future, and move up as they go along with that investment and add value, and then get out and go back down to the bottom of no cash flow, make improvements, right? Come back up, create value that way. I know investors all over the country, and we talk to them. I say, why do you buy at these really low, maybe kind of a middle ground here from zero cash flow to none. In the middle are low cash flow deals. And I ask them, why are you buying that at such a low cap rate and such a low investment grade? And they'll say, well, because I think the property's going to go up in value. I'm in a gentrifying neighborhood and whatnot. And so I'm not buying for cash flow. I'm buying for property value increases. So that's another middle road way of looking at timing the market. Here's another one that I took down in my notes, and that's what if you're an investor and you're really good at construction and you have skills with hiring contractors, you have contacts, you know how to find good contractors that are honest and do good work and their pricing's fair, and you know that you can count on them to show up when they're supposed to. Or maybe you're at the other end of that extreme and you don't know anybody in construction. You wouldn't know a good painter from a plumber, from a framing person to HVAC, all these different trades. You wouldn't know how to evaluate their work at all. And so you're not good at construction. So a project that needs a lot of hands-on rehabbing work or improvement work is terrible for one of those investors and perfect for the other one. So you're timing the market based on your skills of what you can add to the deal or not. So think about it in that way. This is all about timing the market for you as an investor or your team. And that's another point, bring in the people that complement you. If you're good with construction, you're going to be a good fit for somebody who doesn't know anything about it, and you guys could be partners on a deal and really create some opportunities. So when I say timing the market, I really mean that. Make it a win-win for both sides, because your deal is coming together based on the timing that's right for you, based on your needs, based on your skill set and your asset allocation and whatnot. So time the market the right way for your personal needs. Thank you. We'd love to talk to you about your deal, whether you're buying or selling, and we'd be happy to help. Thank you.